Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, the Guardian and the Challenger go head-to-head on 4.55% guaranteed, F.S.C.S protected, tax-free in an I.S.A. Cash has never looked this good. Let's get into it.
For 0.55% guaranteed, F.S.C.S protected, and tax-free in an I.S.A, our cash has never looked this good. For the first time since 2007, savers are earning a positive real return, and you don't have to lose a minute's sleep over it.
And that's exactly the trap. Your £10,000 earns £455 this year, sure, but in a global equity tracker it historically turns into £26,500 after a decade. You're celebrating a rounding error.
Historically. That word is doing an enormous amount of heavy lifting in your argument. The FTSE 100 went literally nowhere for 15 years after the dot-com crash.
Which is why I said global equity tracker, not the FTSE 100. A diversified global index has delivered roughly 8% nominal over almost any 25-year period you care to pick.
Over 25 years, maybe. But most people saving aren't on a 25-year horizon. If you need the money in 2 or 3 years, for a house deposit, a wedding, anything real, a 20% drawdown wipes out years of those historic returns.
I'll give you that. Short-term money absolutely belongs in cash. But the £1.9 trillion sitting in UK bank deposits isn't all earmarked for house deposits. A huge chunk of it is long-term money being parked in cash out of fear.
Or out of rationality. F.S.C.S protection means zero counterparty risk up to £85,000. Name me an equity investment with zero risk of loss.
You're conflating risk of loss with risk of falling behind. Inflation at 3.9% against your 4.55% rate gives you a real return of 0.65%. That's not wealth building, that's treading water.
Treading water beats drowning. And 0.65% real is positive, something savers haven't had for over 15 years. That matters psychologically and financially.
But here's what you're not telling people. Those rates are falling. The Bank of England has already cut from 5.25% to 3.75%, and markets are pricing in at least 2 more cuts this year. Your 4.55% has a shelf life.
Sure, rates will come down. But slowly, the MPC is moving in quarter-point steps, and sticky services inflation means they're cautious. You're not going to wake up to 2% savings rates overnight.
No, but you will wake up to 3% savings rates within 18 months. And by then equities will have already priced in the recovery. The time to invest is before rate cuts boost asset prices, not after.
That's market timing dressed up as strategy. You're asking ordinary savers to predict when rate cuts will boost equities. That's exactly the kind of thinking that gets people burned.
It's not timing, it's maths. Equities don't care about the Bank of England rate the way cash does. Corporate earnings grow regardless. You're tying your entire return to one central bank's decisions.
Let's talk tax, because the maths favors cash more than people realize. The personal savings allowance gives basic rate taxpayers £1,000 tax-free, and a cash I.S.A on top of that means most people pay literally zero tax on their savings income.
And a stocks and shares I.S.A gives you the same tax-free wrapper with uncapped upside. The tax argument is a wash. Both vehicles shelter returns from HMRC.
Except that outside an I.S.A, the £1,000 PSA covers most savers entirely. Capital gains tax just went up to 24% on shares. If your equity gains spill outside an I.S.A wrapper, HMRC takes a bigger bite than ever.
Fair point on capital gains tax, but that's an argument for using your I.S.A allowance wisely, not for avoiding equities altogether. Put your growth assets in the I.S.A and your cash outside it where the PSA covers you.
Now you're making my point for me, even you're admitting cash has a role. The question is how much, and I'm saying for anyone with a time horizon under 5 years, it should be most of it.
Under 5 years, agreed. But here's the problem. Survey after survey shows the average UK saver doesn't distinguish between their emergency fund and their long-term wealth. They dump everything into a savings account and feel clever because the rate starts with a 4.
And what's wrong with feeling secure? Not everyone has the risk tolerance or the financial literacy to ride out a 30% market crash without panic selling at the bottom.
That's a solvable problem. It's called a diversified portfolio and automatic contributions. Volatility is the price of admission to real wealth building, and over any 20-year period it has always been worth paying.
Always is another word doing a lot of heavy lifting. And you just don't panic sell is easy advice to give, much harder to follow when you've watched £50,000 become £35,000 and you're not sure it's coming back.
Which is exactly why you keep 6 months' expenses in cash, your emergency fund, your short-term goals, all guaranteed. But everything beyond that. Every year it sits in a savings account instead of the market is a year of compounding you never get back.
Compounding cuts both ways. A 20% drop followed by a 20% gain doesn't get you back to even, you're still down 4%. Cash compounds predictably, equities compound chaotically.
Over short periods, yes. But £10,000 compounding at even 7% nominal doubles in a decade. At 4.55%, which is already falling, it takes nearly 16 years. Time is the one resource you can't earn back.
Look, I'm not saying never invest. I'm saying right now, in March 2026, with positive real returns on cash for the first time in a generation, the opportunity cost of caution is the lowest it's been in years.
And I'm saying that's exactly when complacency sets in. The best time to build equity exposure is when cash feels comfortable, because by the time cash rates drop and everyone rushes back to markets, prices will already have moved.
My final point is simple: £10,000 guaranteed is worth more than £10,800 probable. For real people with real bills, certainty has a value that no spreadsheet captures.
And mine is equally simple. The most expensive choice in 2026 isn't losing money, it's standing still while your purchasing power quietly erodes and compound growth passes you by.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.